Hello and welcome back to another stock analysis on Stock Market Palantir. Make sure to subscribe and let us know your thoughts in the comments. Now, let's hear from our analysts.
All right, let's dive right in. We're looking at the truly confounding price action around Urgently Inc. That's NASDAQ ULY. This microcap tech firm is, well, it's presenting one of the most acute cases of conflicting signals I think we've seen all year. As of late December 2025, ULY has been trading in a really violent range, fluctuating between $1.81 and a high of, $2.52? And on heavy volume, too. So the critical question is, what is truly driving this price suppression?
And that divergence is exactly what makes it so compelling. The market is just deeply divided here. And the volatility, it reflects a core philosophical disagreement on what matters right now.
Absolutely. My position is that the current trading range is fundamentally detached from the company's real progress. I'm contending that the price is suppressed despite a successful operational pivot toward profitability and strategic growth. It suggests the stock is being fundamentally mispriced, offering, massive long-term potential.
See, and I approach this puzzle from the structural side. The operational gains are, they're interesting, but I think they're irrelevant right now. The price action, and especially that persistent suppression we're seeing, is overwhelmingly dictated by precarious, non-fundamental risks. I'm talking regulatory compliance, the crushing weight of the balance sheet, and some pretty hostile market microstructure dynamics.
Okay, let's start with the facts of the turnaround then. The market skepticism, with the stock hovering near $2, it just contradicts the forensic evidence of a successful transformation. Look at the analyst coverage. Two firms maintain a strong buy with a theoretical price target of $11.50. That implies a potential upside of over 500%. And this optimism isn't baseless. It's rooted right there in the Q3 2025 report.
I understand the allure of a 500% upside, but we have to be pragmatic here.
Pragmatism requires recognizing that management achieved a critical psychological and fundamental threshold in Q3. They generated a non-GAAP operating income of $123,000. This is the first verifiable shift from deep loss to profit in years. And this wasn't a fluke, it was discipline. They increased gross margin by 400 basis points, a jump from 21 to 25%, while cutting non-GAAP OPEX by 25%.
Okay, I agree that the margin improvement is impressive. It's proof of operational capability. Management is clearly executing on a strategy to, call those low-margin legacy roadside assistance contracts to pivot toward higher-margin SaaS revenue. But when we talk about a turnaround being validated, we have to look beyond a $123,000 profit. That figure is negligible when you stack it against the company's immediate existential structural threats.
Well, I would argue that those structural threats are already fully known and possibly over-discounted. And beyond that, the operational success goes beyond just margins. Look at the strategic validation. The partnership with Sony Honda Mobility for their new Afeela EV. That's not just some marketing deal. It confirms that ULY's platform is high quality, zero latency, and mission critical. That partnership provides a fundamental, non-negotiable narrative floor that I think limits the ultimate downside.
Narrative floors don't pay off debt, and they certainly don't satisfy NASDAQ listing requirements. I contend the price is driven entirely by two clear and present dangers. The most significant is the September 22, 2025 NASDAQ Notice of Noncompliance. We're talking Listing Rule 5550B. This is the minimum market value or stockholders' equity requirement. They need to sustain either a $35 million market cap or $2.5 million in equity.
Which they are clearly failing to maintain right now, making the risk binary.
Exactly. It's a binary event. If the NASDAQ panel denies their extension request, it triggers immediate delisting. And this isn't just moving to another trading venue. It forces a massive, indiscriminate institutional liquidation. Major funds operate under strict mandates that prohibit them from holding securities on the OTC pink sheets, forcing a sale regardless of price or value. This regulatory sword of Damocles hangs directly over the stock, and frankly, supersedes any Q3 operational successes. On top of that, the balance sheet risk is terrifying. $61 million in principal debt versus only $4 million in cash. That's a 1 to 15 cash-to-debt ratio. It leaves zero room for error. The market looks at that cash position and sees a company fighting for its life, not one prepping for a 500% upside.
I acknowledge the severity of the debt. I do. But the 400 basis point margin improvement isn't just a nice metric. It's proof of concept that management can generate cash flow from a healthier core business. This disciplined approach is the only viable organic path to addressing the debt over time. They're sacrificing top-line revenue, which, yes, declined 9% year over year, to ensure that the remaining revenue is highly profitable. They are fixing the underlying engine so that future cash flow can actually service the debt.
That's a reasonable long-term vision, but timing is the problem. The leverage is far too extreme for the time horizon allowed by the debt covenants, especially concerning their asset-based lending, or ABL, facility with MidCap Financial.
Can you elaborate on the ABL mechanism here? Because I think that's a really key piece of the liquidity puzzle.
Certainly. So the ABL facility is governed by a borrowing base that's tied directly to their accounts receivable. In simple terms, the amount of cash they can borrow is directly related to the value of the short-term debts owed to them by customers. Since revenue declined 9% in Q3, that means their pool of eligible collateral, their accounts receivable, shrinks automatically.
So their maximum available credit line also shrinks.
Precisely. This creates a dangerous liquidity trap. Credit access decreases at the exact moment they're under duress and might need a cash injection the most. The market understands this complexity. They see the Q3 profitability, sure, but they also see the debt mechanisms tightening the noose. Survival hinges entirely on continuing to expand operating income at a rate that allows them to service that $61 million principal without tapping into a shrinking credit line. The pressure from that debt far, far outweighs the good news of the margin expansion in determining the current price.
Okay, and this leads us directly to the mechanism of price suppression itself. We can't just assume this low price is an organic mispricing driven by fundamentals. The price action is being dictated by market microstructure. Data from early December paints a clear picture. I mean, just look at the aggressive supply hitting the order book.
Off-exchange short volume trading, often done in dark pools, peaked at nearly 63% on December 2nd.
63% is. Yeah, that's an extremely high figure for off-exchange.
This heavy, non-displayed supply, often facilitated by sophisticated market makers, it just absorbs every ounce of demand that comes into the market. It prevents any natural breakout, regardless of positive Q3 earnings. The price is being intentionally capped by players who are leveraging non-transparent mechanisms.
Well, while that intraday dark pool volume is a genuine ceiling, I think the market needs to distinguish between HFT inventory management and a deep, fundamental bearish conviction. We have to look at the official overnight short interest position. It is relatively low, only 4.62% of the float. And more critically, the days to cover ratio is just 0.83.
You keep focusing on that low days to cover figure, but I would argue that metric is irrelevant when we're dealing with this kind of algorithmic high-frequency shorting. Market makers don't get trapped. They use dark pools to constantly refresh and manage inventory. They sell short into demand, and then they cover moments later. They're just transactional facilitators. A low days to cover simply confirms that large entrenched hedge funds aren't making a long-term bearish bet on the failure of ULY.
That's exactly my point. The price suppression is transactional. It's designed to facilitate flow and maintain liquidity rather than being existential, driven by a conviction that the company will fail. If major hedge funds believed this company was certain to fail because of the NASDAQ rule or the debt, the short interest would be 20, maybe 30%, and the days to cover would be 5 or 6. The structure of the short position suggests the technical suppression is temporary and elastic.
But even if the suppression is transactional, the outcome is the same. The price remains anchored below 250, ensuring that NASDAQ Rule 5550B stays in play. The regulatory clock supersedes everything. The NASDAQ hearing is a binary event, and the entry of new institutional holders like Highbridge Capital and DRW Securities, that reinforces this focus. These are not long-term value investors. They're known for volatility and arbitrage strategies.
So what specifically does the entrance of an arbitrage firm signal in this context?
It suggests they are purely playing the risk event of the hearing. They enter the trade anticipating significant volatility or maybe a merger-acquisition scenario related to resolving the debt. They are not buying the potential $11.50 price target. They are buying the possibility of a quick $1.50 swing in either direction based on a regulatory ruling. Their presence confirms the market is focused on the immediate, externally imposed risk, not the internal profitability pivot.
I would frame the institutional positioning differently, though, based on the broader rotation we saw earlier in the year. Look at the 13F filings from the first half of 2025. Major, large-scale, long-only funds like Vanguard and Mythac Capital. They've already removed significant chunks or even 100% of their positions. This capitulation by traditional holders often signals that the weak hands have already sold.
The stock has been thoroughly de-risked from a long-only perspective.
Precisely. So if the long-term institutional base has already priced in the worst-case debt and delisting scenarios and sold out, the remaining flow is held by strong hands or these ARB players. This suggests the stock may be very near a fundamental bottom regardless of the short-term regulatory noise. The current ARB players are simply capitalizing on volatility that's already there, not creating the underlying problem. Okay, let's look past the noise and address the charts themselves, which I think provides strong evidence for the bottoming thesis. If we look at the technical setup, it strongly suggests a potential violent reversal is imminent. Specifically, the Williams %R indicator is flashing a deeply oversold signal at minus 83.78.
And what does that specific oscillator signal tell us in human terms?
It's essentially shouting that the stock has been beaten down past rational psychological limits. The Williams %R measures the closing price relative to the high-low range over a set period. And historically, values sustained below minus 80 often precede a sharp mean reversion rally. This technical exhaustion signal could perfectly coincide with seasonal tailwinds, the Santa Claus rally, and the end of tax loss selling we see in mid-December.
I'm just not convinced by focusing on a single oscillator against overwhelming trend data. Betting on the Williams %R bounce is a counter-trend wager against just overwhelming downward momentum. We have to look at the overall technical setup, which is unambiguously bearish. The stock currently trades below every significant moving average, the 5-day, 10, 20, 50, 100, and 200-day averages.
That is the textbook definition of a bear trend.
Exactly. That defines a strong sell trend, regardless of any short-term oversold oscillator reading. And furthermore, the market is pressing hard against the critical technical floor at $1.80, which is support 1. If that level breaks, it triggers automatic stop losses across the board, targeting the next psychological flush level, likely around $1.76. The charts are signaling a continuation of the decline, not a reversal.
So to summarize the argument for operational value, Urgently has proven the viability of its new high-margin model by achieving profitability and securing a key partnership with Sony Honda Mobility. The current price of around $2 is, in my view, disconnected from this fundamental progress, creating significant potential for massive upside if, and this is a big if, the regulatory hurdles are navigated successfully. The core story is the successful transformative internal progress, just masked by temporary market pressure and structural fears.
And I maintain that the operational story is a sideshow until the fundamental structural risks are resolved. The $61 million in debt and the looming threat of NASDAQ delisting. These are non-negotiable existential threats. The market skepticism, which is validated by that persistent dark pool shorting and an undeniable bearish trend, is entirely rational. This isn't a battle of potential. It is a battle for survival. The market is weighing a modest operational success, that $123,000 profit, against the risk of total institutional failure.
It is indeed a high-stakes dual narrative situation. The complexity here, blending genuine fundamental turnaround success with severe structural distress, it makes ULY a compelling study of market priorities when liquidity is constrained.
And whether the internal discipline can ultimately overcome the external pressure of debt covenants and the NASDAQ panel is the ultimate verdict awaiting the market. Both the liquidity runway and that regulatory decision will determine if that $11.50 price target is a fantasy or, somehow,
a future reality.
If you enjoyed this video, subscribe to the Stock Market Palantir channel for more stock reviews like this. Thanks for watching, and see you next video.